What's up, guys? It's Morgan from Lynchpin. Today I'm going to be talking about the US housing market. Now, before I get into it as a whole, I want to explain a couple of important details. Number one, this is data based on 10 of the most populous counties in the United States. I've excluded a couple from California because half the list would be California, and it has a unique housing market to begin with due to the regulations and additional things there. But on top of that, I want to make clear that housing markets are localized. The reason I want to do a video and include a situation where we're looking at a sample of this data, though, is a lot of times those macro trends do bleed down, but keep in mind it is localized, so you're going to want to look at your specific area, whether that's where you're looking to move or where you're looking to sell, whatever it is. I just want to clarify that. I also have links to where I've gotten all the information, so let's get into it. All right, so first things first, I have an all charts page. Again, I'm going to have a link to the spreadsheet down below. But what I've done is I've compiled all of the charts from throughout the spreadsheet into a single sheet so you can kind of get a summary. So you'll notice that the bright pink is the average active listings, and you can see a comparison of how low those listings are on these column graphs. And then on top of that, you can see the median price by month by county, the number of housing units authorized, active listings as line trends, as well as the median home prices. You got this 30-year mortgage interest rate chart, so you can see that historically we're still relatively low, which may not last very long. But then I want to show you the S&P Case-Shiller Index, Home Price Index, and then the University of Michigan Consumer Sentiment Survey. This is really interesting to these macro trends, again, looking at past recessions and kind of trying to figure out, is there any relevant? And then I've also included a chart with US inflation from 1914, as well as a home sales and price kind of seasonal graph that I found super, super useful. Again, reminding myself whether I'm investing in real estate or just looking to buy a home, this is important details. So let's get into some of the data. Over here, we've got the average active listings by month by county, and this goes up until February of 2022. Now, you'll notice we're late into March. We're 2/3 of the way through March. Why would I do a video then? The housing market is slow. It takes a lot of time to develop. It's not necessarily going to shift overnight. If you think about the situation that I was in, the housing market crash started in about 2007. I bought my home in 2012, and that was absolute bottom. It wasn't because I was smart. It just happened to be when I was ready to buy a home. So just keep that in mind, that it does take some time. Now, if you look across these locales, you'll see that most places, the listings are down significantly, with the exception of New York. Both Kings and Queens County, New York, are up. Now, if we go over and look at the list prices, the median home price for these, you'll notice those also went down. Then you have Cook County, Illinois, which is the Chicago area, and then actually Dallas is basically flat based on that data over the 12-month period, as well as the difference in value this month. Now, as I said again, I like to look at these charts as a column. Kind of shows how outstanding this has been if you own a home, but at the same time, these rise in prices are significantly higher. And also keep in mind that, here's the current median price, and then these are the averages from July to February. So just keep that in mind. Now, affordability and sentiment, I like to look at this because we're a consumer-driven economy. So basically, this just compares what the national home prices are doing versus consumer sentiment. And it's this disconnect right here I'm most interested in. Do I think they're directly correlated in every facet? Not necessarily, but I think it's interesting and worth noting. Next, we have inflation, and the inflation numbers are also through February. And I just want you to notice that, again, looking back, it's not that we're at a peak yet, but we're almost to this inflection point. That's where I think the Fed is going to get stuck between a rock and a hard place, trying to decide what to do, and why I think there's going to be significant upheaval one way or the other. The reason why the market's talking about 7 rate hikes this year, that would be pretty significant and potentially killing the housing market, in my opinion, because again, it would be so expensive to buy a home. People couldn't afford the payments. Who knows what people could even qualify for at that point. Again, this is just conjecture. I don't want to state that it's necessarily going to crash. All I'm saying is the Fed's either going to overdo or underdo. I don't think they're going to end up in the good range, just something to create stability and less volatility. I think one way or the other, they're going to overestimate or underestimate, which I think leads to issues and more of a chain reaction rather than necessarily like the apocalypse of the market. So anyways, looking at inflation, it's high. It's unreal right now, and you feel it. Now, interest rates, again, this is what's crazy with the 30-year mortgage interest rates. I think this morning I was looking, it was about 4.8%. Correct me if I'm wrong, but it's somewhere in that area for a standard. And then you just see how low they've been, how low they've had it. And in order to curb inflation, if this spikes, I feel like the demand for housing is going to die off and thereby cause prices to fall. I can't call what they're going to do. I don't see them getting to 7 rate hikes, even if it's 25 basis points per rate hike. I still don't see it. I think that's pretty far-fetched with the Fed trying to protect the market. So I see them being more hesitant to get there. Then I have the new residential construction housing units authorized. Now, keep in mind, this is authorized, not necessarily being built or has been built. These are just the authorizations. Again, there's a lot of lack of clarity or a bunch of difficulty in discerning those numbers. But I do find it interesting that we're starting to trend back up, and notice that 2005, 2006, 2007 range, and also the 70s before inflation. If you remember, during this time, there was quite a significant amount of inflation. So I kind of wonder if this peaks out somewhere in this range as well. And then if the housing market starts to correct, that could be a situation. But again, I've kind of went through and I did the decades breakdown, basically how many are being built each decade. Keep in mind that, this is going to vary heavily for the 2020s, because we don't have data. But look at how low 2010 to 2019 is, which is partially feeding into this. Then I have a breakdown of all the individual data. This all comes from the NAR website. Again, the link is down in the description. So go ahead and check it out if any of those metros are, of interest to you. Basically, I broke it out again by county. So that's what I've used, because I feel like at a county level, you get a better feel for kind of the local housing market. States can work, but it depends on the state. And obviously you're going to have rural areas and much more metropolitan areas. So you're going to want to take that into consideration. So I get this question all the time. When is the housing market going to correct? When is everything going to fall back down to levels? Listen, I'm in that camp of, I don't think we're ever going to return back to what we thought was normal. I've come to the opinion that with all the money printing going on, millionaires are going to become much more frequent, if you will, just due to the amount of money flowing in the economy. So I think $1 million doesn't mean what $1 million used to mean. And in saying so, that's what also leads me to believe that, yes, home prices may fall some, but I don't think they're going to fall back down to prior levels. Wages are not obviously keeping up, and they are slower to keep up than a lot of other items out there. So I'm not necessarily saying that it's going to be 2008 all over again, but I do think the economy's on a razor's edge to some extent. And I think the Fed, whatever decision they make, it's going to be the wrong one, to be quite honest. I think they backed themselves into a corner with quantitative easing and all of those things, that I'm really skeptical that we're going to be able to come out of this unscathed. And it's less to sow discord and fear, but it's more just the fact of, we're at unprecedented levels in every single market. And the volatility recently, I think, is only the beginning. But give me your thoughts down below. Am I reading too much into uncorrelated data that doesn't make any sense? Am I looking at the wrong things? But for me personally, I think right now the housing market's crazy. I think it's due for a pullback, but we'll see. I think it's got to be triggered. I don't think rates alone will trigger it, but I think with all the geopolitical strife and everything else going on, that really all of that together is going to combine to start to depress prices. And maybe if inventory starts to catch up, that is one thing I do want to mention that's super vital, is keep in mind, if you're selling a house and buying a house, inventory doesn't go up, folks. You've just one-to-one yourself out of inventory. So that doesn't change anything. Fundamentally, what we need right now is a lot more houses than there is demand for houses. And that is the supply and demand problem of the current situation of, if you're moving out and buying another house, no new inventory is actually coming onto the market. So keep that in mind as you think about how many houses need to come onto the market for us to get back to normal. Right now, we're at about a third of inventory across the board in all of these major areas. And so I think that's something to consider. But again, I'd love to get your thoughts. Thanks so much for stopping by. Hope to see you again real soon. Bye.